Before we get into today's topic, if you are new here, welcome. This channel is updated every single day with the latest news, changes, and tips for Canadian pensioners. We have covered everything in simple language, no jargon, just the information you actually need. Hit subscribe and turn on notifications so you never miss an update that could affect your pension or your pocket. Now, let's get into today's video. If you have an RRSP, a registered retirement savings plan, there is a deadline coming that most Canadians do not fully understand. And if you miss it, or if you simply let it happen without any planning, the government could take more than half of everything you have saved, not over many years, in a single tax year. I am not exaggerating. For someone with a significant RRSP, we are talking about a tax bill that can wipe out decades of careful saving in one stroke. But here's the good news. If you know what is coming and you take a few smart steps beforehand, you can protect a large portion of that money, reduce your tax bill significantly, and make sure more of it ends up with your family instead of the government. That is exactly what we are covering today. Welcome. My name is Martina, and today we are talking about the RRSP to RRIF conversion, what it is, when it happens, and most importantly, how to handle it wisely. If you are 60 or older and you have an RRSP, this video is for you. And even if you have already converted to a RRF, there are strategies in this video that could still reduce your taxes and protect your income right now. We are going to cover the mandatory deadline, how much you are required to withdraw each year, how those withdrawals affect your government benefits like OAS and GIS, and a powerful planning strategy called the RRSP Meltdown that could save you thousands. I will also share something that catches a lot of Canadians completely off guard when their spouse passes away, a tax situation involving the RRIF that most couples never plan for, and deeply regret not addressing sooner. Stay with me until the end because the last section of this video is one of the most important things any Canadian senior with a registered account needs to hear. Let us start from the very beginning because a lot of people are unclear on what the conversion actually means. Your RRSP is a savings account where your money has grown tax-free over the years. Every dollar you contributed was a tax deduction. Every dollar of interest, dividends, and growth inside that account has never been taxed. The government has essentially been a silent partner in your savings, letting you grow that money tax-free in exchange for a promise that one day the taxes will be paid. And that day arrives by law at age 71. The rule is simple. By December 31st of the year you turn 71, your RRSP must be converted. You have three choices. You can convert it into a RRF, a registered retirement income fund, and which is the most popular option. You can use the money to purchase a type of guaranteed income called an annuity, or you can simply cash it all out at once. Now, cashing it all out at once is almost never a good idea because the entire balance becomes taxable income in that 1 year. If you have $200,000 or $500,000 saved up, you could be paying the highest possible tax rate on most of it. That is the scenario we want to help you avoid. Most people choose the RRIF, and here is what a RRIF means in practical terms. Your money stays invested. You can hold the same stocks, bonds, or mutual funds you had in your RRSP. The account still grows tax-free. But now, each year, you must withdraw a minimum amount. You cannot leave all the money sitting there any longer. The government sets a percentage based on your age, and that percentage gets larger as you get older. At 71, you must withdraw about 5.25%. By 80, it is close to 7%. By 90, it is nearly 12%. The older you get, the more you are required to take out each year. Now, here's something reassuring. If you turn 71 in 2026, you do not actually have to take your first RRIF withdrawal until 2027. You get a 1-year grace period after the conversion. That is a valuable window for planning, and I will explain how to use it wisely in a moment. Here is where things get really important and where a lot of people are caught off guard. Every dollar you withdraw from your RRIF is counted as taxable income. It gets added to everything else you receive, your CPP, your OAS, any rental income or investment income. And when all of that adds up, it can push you into a higher tax bracket. But more than that, it can trigger something called the OAS clawback. Here is how the clawback works. If your total net income in a year goes above a certain level, in 2026, that threshold is just under $96,000, the government starts taking back your OAS pension. For every dollar you earn above that line, 15 cents of your OAS gets clawed back. If your income gets high enough, you could lose your entire OAS payment for that year. Now, for most seniors, the OAS clawback is not an immediate concern. But if you have a large RRIF balance and you are also receiving CPP and OAS, the mandatory withdrawals can stack up quickly. Someone with $1 million RRIF at age 72 would be required to withdraw over $50,000 that year. Add CPP and OAS on top of that, and you are already close to that threshold without even touching any other income. This is why planning ahead, before the withdrawals become mandatory, makes such a significant difference. For lower-income seniors, there is a different and equally serious concern. If you receive the Guaranteed Income Supplement, the GIS, every dollar you withdraw from your RRIF is counted against you. The GIS gets reduced by about 50 cents for every dollar of income you report. So a low-income senior who is forced to take a mandatory RRIF withdrawal could find that their GIS drops sharply at the same time. In some situations, the combination of income tax and GIS reduction means that the effective tax rate on an RRIF withdrawal for a low-income senior can reach 60% or higher. That means for every $100 taken out of the RRIF, only $40 actually ends up in the senior's pocket. That is a painful reality, and it is one of the strongest arguments for using a TFSA instead of an RRSP for lower-income Canadians during their working years. Now let me tell you about the strategy I mentioned at the beginning, the one that could save you thousands. It is called the RRSP Meltdown, and despite the dramatic name, it is actually a very calm and methodical approach to protecting your savings from unnecessary taxation. Here is the core idea. There is a window of time, usually between when you retire and when you turn 71 and when your income is at its lowest. Your employment income has stopped. You may not have started CPP yet. You may not be receiving OAS yet. Your tax rate during this period could be the lowest it will be for the rest of your life. This is the perfect time to voluntarily take money out of your RRSP before you are forced to. Why? Because you pay tax at a lower rate today, and you reduce the size of the account. A smaller RIF at age 72 means smaller mandatory withdrawals. Smaller mandatory withdrawals means less chance of triggering the OAS clawback, less stacking of income, less tax, more money in your pocket over the long run. The money you pull out during this window can be moved into a TFSA, where it will continue to grow completely tax-free and never be counted against your GIS or OAS. Or it can be placed in a regular investment account where at least the growth is taxed more favorably than regular income. Let me make this real with an example. Imagine a woman named Patricia. She retired at 63. She has not started her CPP yet, and she is not receiving OAS. Her income is relatively modest. She has $350,000 sitting in her RRSP. Instead of letting that account grow untouched until 71, Patricia starts withdrawing about $20,000 a year. She pays tax on it at a low rate, maybe around 20%. She moves the after-tax amount into her TFSA. By the time Patricia turns 71, her RRIF is significantly smaller. Her mandatory withdrawals are lower. Her total annual income is more manageable. She never triggers the OAS clawback, and her TFSA has grown substantially. The early withdrawals that felt uncomfortable at the time end up saving her tens of thousands of dollars in tax over the next 20 years. This is the meltdown in action. It is not about withdrawing everything at once. It is about slowly and strategically reducing the registered account during your lowest income years so that the mandatory withdrawals later are as manageable as possible. Now, here's a strategy that many couples do not know about, but that can make a meaningful difference if one spouse is younger than the other. When you set up your RRIF, you have the option to base your minimum withdrawals on your spouse's age rather than your own, but only if your spouse is younger. Why would you do that? Because younger age means a lower withdrawal percentage. If you are 71 and your spouse is 63, using your spouse's age could reduce your mandatory annual withdrawal by nearly 30%. That means more money stays in the tax-sheltered account longer, growing quietly for you without triggering extra income each year. This election must be made at the time you set up the RRIF. You cannot go back and change it later. So if this applies to your situation, if your spouse is younger than you, please make sure you discuss this with your financial institution or advisor when the conversion happens. It is a one-time decision with long-term consequences, And while we are on the topic of couples, there is another powerful tool available from age 65 onward called pension income splitting. Once you are drawing from a RRIF, you are allowed to split up to half of those withdrawals with your spouse for tax purposes. This means if you are in a higher tax bracket and your spouse has very little income, you can legally shift some of that RRIF income onto their tax return. The result is a lower combined tax bill for the household. This is done each year on your tax return, and it can also help you stay below the OAS clawback threshold by reducing the income reported in your name. It is one of the most effective and completely legal tax reduction tools available to Canadian couples in retirement. Now, I want to tell you about something that most couples only discover when it is too late, and it is the reason I asked you to stay until the end. When a person with a RRIF passes away, the entire value of that account is treated as income in the year of death. For a large account, this tax bill can be enormous. In some provinces, more than half the account value could go to taxes on that final return. The government effectively becomes the largest single beneficiary of the estate. The way to prevent this, or at least to defer it, is something called the successor annuitant designation. This is different from simply naming your spouse as the beneficiary of the account. When you name your spouse as a successor annuitant, the RRIF does not get collapsed at your death. Your spouse simply steps into your place and continues receiving payments from the same account, exactly as before. There is no tax triggered at the time of your death. The account continues, the investments continue, and the taxes are deferred until your spouse eventually draws down the account over their lifetime. This one designation on a form, done when you set up your RRIF, can save your family a massive tax bill at one of the hardest moments of their lives. If you are already in a RRIF and you have not confirmed that your spouse is named as a successor annuitant rather than simply a beneficiary, please check on that as soon as possible. It is a simple administrative step that makes an enormous financial difference. And for those who are worried about outliving their savings, there is a relatively new government-approved product called the Advanced Life Deferred Annuity, or ALDA. You can move up to a set amount from your RRIF into an ALDA, and that money does not have to start paying out until age 85. This does two things. It reduces your mandatory RRIF withdrawals in your 70s and early 80s because the money moved into the ALDA is no longer counted in your RRIF balance, and it guarantees you a steady income floor from age 85 onward when other savings may be running low. Think of it as insurance against living a very long life. Before we close, two quick reminders that connect to everything we have covered today. First, and in 2026, there is a new benefit called the Canada Groceries and Essentials Benefit. It includes a one-time top-up payment arriving on June 5th and higher quarterly GST payments starting in July. But eligibility depends entirely on having filed your 2025 tax return by April 30th. If your RRIF withdrawals or any other income changes apply, make sure your tax return reflects the correct picture this year. Second, if you are enrolled in the Canadian Dental Care Plan and your household income is under $90,000, your coverage must be renewed between April 15th and June 1st. Miss that window, and your dental coverage ends July 1st with no retroactive reimbursement. These are two deadlines that have nothing to do with your RRIF, but they matter enormously to your overall financial and health security in 2026. Let us bring it all together. If you have an RRSP, it must be converted by December 31st of the year you turn 71. The most common option is a RRIF, where your money keeps growing tax-free, but you must take out a minimum amount each year based on your age. Those withdrawals are taxable income, and if they are large enough, they can affect your OAS and your GIS in ways that are painful and avoidable. The smartest approach is to start planning before age 71, ideally in your early to mid-60s, by taking some money out of your RRSP voluntarily during your lower income years and moving it to your TFSA. This shrinks the account, reduces future mandatory withdrawals, and lowers your lifetime tax bill. If you have a younger spouse, use their age for your RRIF withdrawals, split your pension income each year, and make sure your spouse is named as a successor annuitant, not just a beneficiary, so the account passes to them smoothly and without a massive tax hit. The RRIF is not something to fear. It is simply the next stage of your savings journey. But like every stage, it rewards those who understand the rules and plan ahead. If this video helped you think about your RRSP or RRIF situation a little more clearly, please share it with a friend or family member who might be approaching that age 71 deadline. This is exactly the kind of planning conversation that too many Canadian families never have until it is too late. And if you are not subscribed yet, please do. We post new videos every single day covering Canadian pension updates, benefit changes, tax tips, and practical financial guidance for seniors, all in plain, simple language without the jargon. Tap subscribe and turn on the notification bell so you never miss a video that could protect your retirement income. Thank you so much for watching all the way through. Take good care of yourself, and I will see you tomorrow.